Welcome to the Winner's Playbook with Steve and Josh. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book a free 15-minute call to discuss your personal situation.
Okay, welcome back to the Winner's Playbook. My name is Steve Sloan. I'm here with my colleague and co-director, Josh Lee. Josh, another big week as normal. Mate, what was your key items for this week in your financial world?
Big week indeed. And I suppose we come off the conference last week. So we were at a conference last week with, I think, like 300 odd advisors from around Australia, which was really good. And there was actually some interesting speakers there. We actually got to hear from some other business owners, which was quite cool. One lady that had started a croissant business, one guy from Four Pillars Gin, and they kind of spoke about their story and how they got started in the business and all of the things that they've gone through to make a successful business. And there was obviously, so many different things that you can actually relate to in terms of what they're saying. So I suppose it doesn't really matter what business or venture you're in. Everyone has the same problems that they go through, which was quite interesting. At the moment as well, we're actually planning out a bit of a Euro trip, Steve. So I'm going to be taking off in a few months and catching some sun before the kids come along in my life. So we're trying to get away and actually see a bit of the world before life gets a little bit crazier. So
good for some. It's good for some. Yeah.
Yeah.
Well, look, before we go there, like let's unpack last week, because there were some really good speakers, and it was good to see, these entrepreneurs coming to the stage and bringing it all. That Four Pillars Gin, based out of Melbourne, I believe the Yarra Valley, and they started from scratch. Never really worked in gin before, but they one of the three partners, one of them had worked in wineries before, but decided to come together as a group and really start up a brand new gin company and take on the big boys, right? The Heinrichs and the guys who really killed it in the world of gin. And then ended up beating them and becoming number one as a global seller in some of the regions of the world. And then we had the lady that started Loon Bakery in Melbourne, and she was originally an engineer for a motorsport company and just totally took a tack and went into baking croissants, where she learnt the skill set in France for, I think she said, a 12-week course. Adapted that back to Australia. If we think about the key takeaways, and I got some very similar messages last week about what those entrepreneurs are saying, what drives them, and what they had to do to get there. What did you see from that?
Yeah, there was a lot. Like some of them, I actually wrote down obviously a lot of notes from the session. I was just actually looking at some of them that I had, because it was all about like high performance and bits and pieces there. But a couple of them was like, failure drives change. And, all of these guys, in terms of what they did in creating their businesses, like it was just constant failure. They didn't get to where they are, and now it's all successful, in one go. So there was a lot of setbacks along the way. But I think the key thing there, and that doesn't have to be in business, in any aspect of your life, when there's a setback or a failure, you just got to look at it and actually learn from it, and then learn not to then do it again, and you become a better and wiser person because of it. And I think one of the biggest ones that's actually resonated with me, and I forget exactly who said it, but it was, when you're on top, or when you think you're on top and you're doing well, change your game, because you're never going to get to where you want to be, or that next level of where you're trying to take your life personally or as a business, if you keep doing all of what you're doing. So there were some real key ones. Obviously, hard work and that work ethic, and as business owners, you're kind of always on. You're dealing with all of the crap, but being creative as well, I think, was another big one, and not just sticking to the status quo of how everyone's always done it. And that's probably those two that we just mentioned there with Loon Croissants and Four Pillars Gin. Well, they were both particular stories of established industries, I suppose, and going at it in their own way and coming up with new ideas, and now continuing to innovate and take it to other levels, and then build a kind of a new sort of business within an industry, and take it to a whole new level. So there was some amazing takeaways. What were some of your key ones?
Yeah, absolutely. You could tell when they're on. So these are very successful people, but even they were talking last week, and they just wanted to go again to the next level, right? And you could just see it by them talking. revenue streams. They constantly looked at how to create new revenue streams, and I think that goes very well with what we do at Link. We're constantly looking for that next level, continually adapting. They both went through very, very, very hard times. One in particular, Loon, who had a COVID shutdown in Melbourne for 18 months or 2 years.
Yep.
She had to think on her feet, and so they did pop-up stands around the state, around Melbourne, to be able to sell their croissants, because effectively they went to zero overnight. But time and time again, they showed that, okay, they get the hurdles in front of them, they just find a way around it and go again. And I think just having that characteristic, and as you said in previous podcasts, you've got to be a little bit crazy to be able to do business. And that's a prime example of just going, right, how do you think out of the box here? It's not for everyone, but you got to go hard and always think, that next level. And I think just always challenging yourself, never resting on your laurels, just going again and continuing to persist. And that was a very similar theme across every single one of those successful entrepreneurs. So it was really, really resonated well, I felt.
Yeah, and what you're talking about there is just, I suppose, adaptability, and for that Loon Croissant example you just said, is when COVID happened down here in Melbourne, like completely shut down, and could have quite easily have done nothing, and she come up with a great idea, and I think she said her business really boomed from them. And that's when all of her social media and everything started to take off, because it was kind of all we could look forward to here in Victoria, and she was going into these different suburbs every couple of weeks or so, and it was exciting. But that adaptability and that open-mindedness, and it was one other one, I think, Tristan Knowles, shout out to him, because his story, the Paralympian for Australia, I think was amazing. And I walked away from that just really amped up, because his story of what he's been through with cancer and everything else was just quite amazing to see his perspective and his attitude still on life. So there was a lot of, it was all about growth, the conference, and plenty of key takeaways and a lot to take away from it, which was really good. But that's not what we're talking about today, is it, Steve?
No, it's not, but it gives us a slight pivot, because those people that we just spoke about have invested in business to make money, and they've obviously put their heart and soul into it, and no doubt are making very good money and growth, and that's fantastic to see that. And that's the alternative to what we're talking about today, which is what is the alternative to investing in property? Because Australians love property, they love investing in property, but is not the only vehicle to make money. And we've probably touched on this a little bit in prior podcasts, but we're going to dive a little deeper into it today. And that's a perfect example. Last week, I've seen those entrepreneurs and in business, and that is one way to make money outside of property is business. And you and I are probably examples of that. We've invested a lot of energy, time, and money into Link Wealth Group and the various entities we own. And that's our wealth journey. We've also done it with property as well, but we have got a lot of our wealth in property. But if we think for a minute, we put business to the side, mate, in terms of that option, we'll probably come back to that. Talk to me about what are the options that people have out there to make money outside property, and why would you step away from that property investment strategy?
It's a real interesting one, obviously, for here in Australia, because everyone absolutely just loves property, and it's really just drummed into you probably from an early age. Your parents are always like, oh, when are you going to buy your first home? And that sort of old school mindset. I think that is a bit of an old school mindset, mind you, of always trying to get your first home and pay it down as soon as you can. But your first home's never going to be your forever home, so I never think of it in that sort of fashion whatsoever. It's more of just a foot into the market. But if we're looking at the other options outside of property, I suppose the caveat I'd say to that is I'm a big fan of property in a overall portfolio, but that's not what the viewers want to hear today. So we're talking outside of that. So that the biggest and notable one there would be, taking up business of what we've already spoken about, stripping property out of it. My next biggest investment class or investment vehicle is just a portfolio of, say, managed funds, ETFs. Call it investing into the share market is really my three key investments of that: property, business, and my investment portfolio of shares, managed funds, ETFs. Now, in terms of your options there's obviously a difference between shares and, say, managed funds and ETFs. Managed funds and ETFs, basically the same thing. It's just how ETFs are traded is a little bit different. But like a lot of people on their investment journey, I was no different and started share trading to begin when I knew absolutely nothing. And I still do have some direct shares shares in my portfolio, but I'm actually trying to sell down on those and get rid of all my direct shares because I don't tend to sort of mess in that space anymore. I prefer to use, an ETF managed fund, index type approach with a lot of my investments. But that's definitely probably my number one alternative to going into property, is starting to consider looking at, say, the share market and looking at those other types of investments. But of course, that also comes down to, your risk appetite and what are you doing with your money as well, is another key thing. Like if it's a long-term investment, shares, managed funds, ETFs, perfect. If you're investing for 8 to 10 years, you want to get that growth exposure where you can really benefit from those compounded returns. But maybe if you're closer to retirement, or maybe you just need you're only investing for a couple of years because maybe you're trying to save some money for something. Maybe it's a Europe trip. I don't know. Maybe it is buying a property in future. You might not want to be as aggressive with some of your investment if you do have a short time frame for investing. So that's probably a key thing to really understand there. But there is a big drawback of not having the property in there as well because of the leverage, which we might touch on of why the appeal is with for property. But what else did you have there, Steve?
Yeah. So look, I think from a set and forget strategy, ETS managed funds, you can't go wrong, right? Because if you're time poor, you don't have time to really look at day to day what's going on. I'm a huge believer in ETFs because you can just stick it in, let it go, let it run, and just keep investing in it. You don't even really have to look at it, right? You invest in thousands of companies around the world. In Australia, let it do its job. Just keep investing. But then if you've got lots of time on your hands, or you really want to get knowledgeable or get your hands dirty, there's plenty of other options out there. So there's listed investment companies. They're listed on the stock exchange. They invest in other businesses to grow wealth. Listed investment trusts. So they're also listed on the stock exchange. But there's also plenty of unlisted types of investments. So you can go into sort of private equity vehicles. I know a lot of funds out there that invest in, they're funds. So you're investing in a fund with lots of other people, and then that money's pulled together, and that fund manager or person goes out and buys other assets in that fund. But there's plenty out there and plenty of companies out there that do other types of investments, like agriculture is a big one. So investing in water funds, for instance, where you can buy water entitlements and invest in that. Buying farms or agriculture, almond farms, avocado farms, whatever it may be. There's so many different options out there. Look, a lot of times some of these options are only available to wholesale investors, which is you've got to have a certain level of income and a certain level of asset base to be able to get access to those. As you see, they see you as a sophisticated investor compared to retail investors, where retail investors are your general lower income or medium incomes, a bit less educated, hence why you can't quite get access to them. But if you're in a different type of category, depending on what part of the wealth journey you're on, you've really got other options you can think about outside the normal listed managed funds or listed ETFs or buying individual shares for that matter. So I think it's about getting educated. If you want to know more, get in touch with an advisor that knows what they're talking about in this space. And you can really open up your world. A lot of the clients I deal with now, we have those conversations, right? Like, because you've set up an ETF portfolio, managed fund portfolio, you've got your property, you've got business, what's next? And there are some very good options out there in the world of investing that you can get access to.
Yeah, and I guess if you don't want to actually buy a physical property, which is what we're talking about here, you can still get property exposure through the means of what you were just saying, REITs, so real estate investment trusts is a way, and that's typically, we do have property exposure in our investment portfolios through using REITs, which basically invest typically in more commercial type assets within a fund. So you can buy an investment option that does give you some broad property exposure without you actually having to go out and buy a direct residential or an investment property for that matter. But another one you're touching on there, Stephen, is always, so I see some people always get confused between managed funds and ETFs because they're similar, but they're not exactly the same thing. Can you just explain in simple terms, like what is the difference between investing through a managed fund versus the ETF versus the ETF? Like what's the major differences there?
Yeah, the single major difference is an ETF is listed on a stock exchange. So it's got a daily share price, like a share. You can buy and sell that share whenever you want and get the money back very quickly. It's very liquid because it's on a share. That share price is exactly what you'll get today if you sell it or buy it, right? A managed fund is not listed on a stock exchange. So it is a fund manager. You generally get access to them through platforms, investment platforms. you're buying units in the fund. So an ETF is like a share price. You're buying that share price. A managed fund is you're buying units in the fund itself. And it's managed by a fund manager who generally is a bit more active. So generally you're buying an active fund manager generally, where an ETF is generally always passive. And what I mean by that is yes, there is a manager of the like who is managing the money and making sure we're buying and executing the right trades, but it's generally just buying an index or a set specific group of shares that are very similar. For instance, an ETF, you're generally buying the ASX 200, for instance, where it's the top 200 stocks on the ASX, and that's all it will do. The manager will make sure that that's executed correctly, but that's all they're doing. And hence why they're super cheap, where a fund manager will be buying and selling those assets maybe daily, maybe weekly, maybe yearly, depending what type of fund management we're buying, but it's not listed. I think that's the biggest part of it. They're not listed on a stock exchange. And generally, if you want a passive strategy, very much set and forget, not even watch it, well, maybe an ETF strategy is for you because it is the index passive way to invest, very low cost. If you want to get a bit more hands-on, a bit more active, yes, you can buy a fund that does index-based investing, absolutely. Generally, probably not as cheap as an ETF in general. But if you want an active manager that goes out there and really is actively in the market trying to seek that alpha or extra return, you'll go to a fund manager specifically to do that, right? Because they won't be in an ETF in general. So that's probably the major difference. But I like ETFs because of liquidity. You take away the risk because at the end of the day, that fund manager can stop redemption. So if you want to get your money back, and for some reason a lot of people have started to liquidate their holdings of that funds at some stage, the fund manager may choose to stop redemptions and you can't get your money back. That it's very unlikely, but it is a risk that is there. And also you get your money back very quickly when it comes to ETFs because listed on the stock exchange and within 3 days you get your money back. So just a couple of things, but they are very similar. They're very similar. Yeah.
An interesting point you said there about the where your money can be sort of locked up, because we're talking about property, and that's actually where some of those funds, it's actually happened with those types of property funds in the past. When the GFC, I remember, I wasn't in the industry back then, but I did see clients that when I started working in the industry around 2017, 2018, they actually had some property funds that were still actually locked up and they couldn't get their money out of the funds all the way from back in 2008, 2009 odd. So funds were still locked up, which was crazy to see. But this is a big question then. What about, is it possible to build wealth without then buying property? Like what do you think there? Like is it truly possible to build a vast amount of wealth or a good amount of wealth without having that exposure to property or owning a property or an investment property, whatever it may be?
Absolutely. But I'd say the second protocol is business. You can make a hell of a lot of money in business. If it's not property business, it's rather difficult to just build a lot of wealth through buying into the market in ETFs or managed funds or shares for that matter, unless you've got a significant amount of money being pumped into it. It is very, very difficult. And to be honest, I haven't seen in my career a lot of people being successful in building a hell of a lot of wealth if it's not with property or business. But absolutely, if it's not property, and definitely property is not for everyone, business has to be the go-to if you want to make a lot of money. It depends what your goals are and what you're trying to hit to and what is a lot of money to that person. That differs for everyone as well. But in my view, it's either one or the other, property or business. Ideally, you want both, right? But absolutely, outside of property, managed funds, ETFs, etc., are very, very good as part of those portfolios. If you're not in business and not in property, but you still want to make wealth, absolutely we can get there, but it's just going to take a lot longer. We need a long journey, 20 years of investing. Just keep on pumping it in, and you'll get there, but it's just going to take a lot longer.
Yeah, because I think a key difference there, and this I suppose applies with business and property, because both of them provide you the ability to leverage, and I suppose in different ways though, and that's the real key difference between, say, shares, managed funds, ETFs versus buying property. Because if you have $100,000 of cash, you could put $100,000 into an ETF or a managed fund or some shares. Whereas with that $100,000, depending upon what you're earning as well, of course, here, you could potentially go out and buy a $500,000 or a $600,000 property with that $100,000 as your down deposit, plus your stamp duty. Of course, assuming you got enough income to then borrow for the loan, because you are taking on debt to acquire that property. And that's really the key difference there, is the leverage. So if you compare that, putting 100,000 into the shares, you've only got $100,000 of asset, whereas you put $100,000 into that property, you've now got a $600,000 asset. So the leverage that it provides you, I think, without having it in your portfolio, it's not making it impossible, but it does make it a lot more difficult to not grow your wealth because of that leverage. Because you're using, I call it OPM, other people's money. You're using the bank's money to help build your wealth. And that can also apply with business, because you can use debt to acquire other businesses and parts that we do within Link Wealth Group itself. But then you can also think about leverage in the business, I think, in a slightly different way, because you're kind of, as a business owner and running a business, you're leveraging on other people's skill sets and all of your staff as well. So it's not just you running a business and you're just running and doing every single thing yourself. You're leveraging off everyone else's capability to then create something better. So that leverage that you get through property may be slightly different in terms of taking out money and borrowing or taking out loans. But with property, you get that leverage as well, just from the staff that you can be working with. And collectively, you're going to achieve bigger things rather than trying to do it yourself.
That's right. Like, Link's prime example, right? We've got 60 staff and you could be able to leverage. And I started Link with $100,000 loan, right? Yeah. That was all. I took a loan off my mum's house for $100,000, and that was the start of Link, right, with one person. So yeah, that just. But I was only able to scale it up through other people, through what you just said, by taking on debt to invest in other, like bring on other businesses into the model, and that got us up and going. But if I couldn't take on that debt, we probably would have been back at square one, right? So yeah, you're 100% right. You need to be able to scale up, but and look, you can take on debt and scale up through shares and managed funds as well. There is an option to do that, but you just got to get the balance up sooner. It's harder to get the debt. It's more expensive to get the debt. So the ROI has to be higher. So there's a range of things sort of working against you, but absolutely it's an option. It's just about timing it right, getting the right, set up correctly. Mm-hmm. But yeah, no, absolutely. It's just about getting it all done. And Meg, what are some of the other things people should be thinking about if they're not going property, apart from just investing in general? What are some of the other, if we step away from the wealth or money side of things and about property, and what are some of the benefits of not doing property compared to doing property, apart from the monetary side?
Yeah, well, there's the stresses of actually having property. That's the biggest one. So, if you've got to share an investment portfolio, you don't really have anything to manage. Like you get your statement, you can log in, look at it, see the value of it. Whereas with your property, I can even talk from personal experience. Like with one of my properties, I've just gone through a period where the tenant didn't pay for 2 months, and fortunately did pay. But now I've even got a client at the moment who's done a similar strategy to me in terms of rent vesting, and they moved out of their home, started renting it. Bought an investment property and then started renting in a new place. So they've done a typical rent vesting strategy. Within 1 month, the tenant stopped paying, and it's been dragging on now for probably 4 or 5 months. That tenant started painting half the house, kicking in holes. This is a legitimate story as well. Wow. I was just speaking to them the other day. Terrible to hear about, but that's actually some of the risk. Now that's a severe scenario though. That's a really severe scenario. But when you've got property, you have stuff to manage. Things can fix, upkeep and all of those bits and pieces. So there's a lot more to actually think about if you're trying to build your wealth through property, as opposed to just put it in. And that's why I actually like my investment portfolio, because I just put money into it whenever I want, which is every single fortnight I invest into that portfolio, and it just really set and forget. I don't need to think about it. Whereas with my properties, property managers pinging me all the time. I had an issue with one of the tenants, and because of the protections and laws, particularly if we're talking investment properties, they're not great. No. So if something goes wrong, you got a lot of headaches there. And like I said, my other clients have had to go through VCAT, and it's been quite painful. But what else would you say there, Steve?
Yeah, you're 100% right. Like, again, personal experience, I had to replace my timber floor. Not long ago, it was $10,000 just for the floor. So, there's 4 months of rent gone. So yeah, it's amazing the upkeep that I don't think people sometimes, when they're getting into investing in properties, don't really understand. Sometimes they think it's all easy and there's no cost, but the maintenance of a property is horrendous sometimes. So yeah, I think you really got to do your homework. Yeah, I think just stress-free, you know, you don't have to worry about shares and managed funds, ETFs, just let it roll. That's amazing. Yeah, but then there's taxation considerations. I think one thing in Australia that we've got to be mindful of is a thing called franking credits. And that is a huge benefit to high marginal income earners, because you're effectively getting a lot of tax back through your investments in the Australian share market. So this is only specifically if you're investing in the Australian share market. We have a considerably favourable system when it comes to getting corporate tax that's already paid by those companies given back to the individuals. And it's huge. It's huge. So I think people really need to consider that taxation system and what that benefit is, because the kicker is massive. So you might look at a return on a fund and go, oh, that hasn't performed too well. But then when you consider the taxation that you get back from that investment, similar to negative gearing, but if you combine the passive income, no stress, no issues, and then all of a sudden you get this huge tax credit back to you as a high income earner, got to do your numbers, because it can be very, very good.
Well, I think that's a good point to sort of finish on there, Steve, is property. Again, property can be a really good asset to build your wealth, because we've spoken about leverage. But in terms of actually getting to retirement, it's generally not that great of an asset to hold in retirement because of, you know, some of what you're saying there, like franking credits, you know, liquidity. So you can't just take $5,000 or $10,000 out of your property. Like, you can't just cut off a slice of it and cash that in. You know, you got to sell it. You're up for taxes and things like that. Whereas when you have an investment portfolio, it's so much more liquid. So property is really good to scale up, but when it comes time to actually retiring, it's generally not the greatest asset. Now, I've got some clients with some decent, really large portfolios, you know, over 10 million, and the amount of land tax and expenses they still have outgoing in retirement is just ridiculous. And that's where they're looking at slowly having to trim down on it. But the property's done its role in terms of building and scaling their wealth. But in terms of at retirement, that liquidity and, you know, franking credits and taxation, I think is a real huge one.
Yep, definitely.
Cool. Well, guys, that's all we've got time for today. So again, appreciate everyone that is listening in. And if you are getting some value from this, 5 stars on Spotify and Apple, greatly appreciated. And feel free to check out the website as always. If you do want to actually chat about your personal situation and possibly get some advice or chat with one of the advisors, not just Steve or myself, feel free to jump on the websites. But besides that, Steve, we'll finish there, and I'll see you on the next one, mate.
See you, mate. Bye.
Catch ya.